What an incredible year. I'm sure anybody related to the real estate industry, anybody who's a homeowner in Canada is eager to turn the page. But to do that and see better results in 2023, we got to understand how we got here in the first place with the fastest pace of interest rate increase on record and the fastest depreciation of home prices on record. A lot of events had to take place in particular order to see that all play out. So going back to 2020, economy shut down, stock market crashes, real estate demand crashes in the short term, and here comes central banks with their monetary policy and federal governments with their fiscal policy to the rescue. We brought borrowing rates down to zero, and here came federal governments with lots of liquidity out there to print money and sprinkle it down to large businesses, mid-sized businesses, small businesses, and consumers. We created a ton of liquidity, and that liquidity had to go somewhere. And eventually, it quickly found a home in real estate. Real estate prices took off. Virtually all asset prices took off. Crypto industry boomed. Stock market recovered, toppled new highs. The economy was buzzing because you got so much money chasing so few goods and services. And as a result, we found ourselves in early 2022 with the housing market in complete frenzy, accelerating price appreciation. But on the back of that, supply chains had broken down and there was still incredible demand. And as the economies reopened up, that money had to go somewhere. And suddenly we started spending on goods and services and inflation ratcheted up. And then we reached sort of a turning point, or things came to a head and central banks had to step in. And that's where we're going to take it from today in this conversation. We're going to understand what happened with interest rates, why, what the impact is, and what we might expect moving forward for existing homeowners and new homeowners. With me today, I've got my business partner, Devin Noble, also a registered mortgage broker in Ontario. I thought today more than ever is so important to bring Devin on so that in this conversation, we can get some additional viewpoints, a lot of nuance, some more context, because considerations for what mortgage to take in the future, what to do about your real estate really need some diverse perspectives. So with me here today is Devin. 2022 in real estate. What an incredible time. We saw both the fastest pace of interest rate increases on record, and as a result, the fastest pace of real estate price decline on record. Now, those things don't happen inadvertently. A lot of cause and effect took place before that were to happen. So I'm going to have Devin give us a better understanding of what took place over 2020, 2021, that as a result, central bankers had to raise rates at the fastest pace of history.
Yeah, well, it's a pretty wild time. We had some pretty quick reaction from central banks to a situation that is really unprecedented. The world has never had a global shutdown, especially one caused by a pandemic. You know, the last pandemic was almost 100 years ago. We've never quite seen something this dramatic, and governments reacted the best way they thought they could, which was to support the population as the economy shut down. Very quickly, though, like we started to realize our economy had more resiliency than perhaps initially expected, and jobs started to get created. The low borrowing costs were taken advantage of, and people were able to maintain their jobs and go remote. And that happened pretty quickly. That's why you saw the stock market rebound. That's why you started to see housing prices climb consistently month over month through 2020 into 2021. And you had the central bankers advising people that rates were going to stay super low for a long period of time. So you create this perfect hotbed of spending without really much concern of, you know, what's coming down the pipeline. And that's roughly what led us up to February 2022. People continued to buy. Supply was hampered by what we know to be, you know, reduced workforces in very key countries that provide most of the goods to our countries in North America, and it just created a perfect storm for a very quickly rising rate of inflation, which needs to be tackled with rising interest rates. And February 22 was kind of that peak. You saw asset prices peak in February, and the central banks really started to turn on the rate hikes into the later half of 2022.
It's incredible when you create that much liquidity in a financial environment, how many sort of downstream effects, how many asset bubbles you could create, not solely in real estate, But it's hilarious how over this time you'll see a crypto bubble sort of percolate, and obviously the stock market take off and hit new highs, and have it so disproportionate with tech obviously running up so much greater than other sectors of the economy. And then the moment you get some tightening in financial conditions, you see the fallout of that. And we won't go down that rabbit hole, but anybody who participates in crypto certainly can resonate with where I'm coming from right now.
Well, that's exactly what you get when you give liquidity directly to the people.
Retail
To the retail consumer. Yeah, and it's never really been done before. You've never had checks delivered to people's hands from the government for being unemployed outside of your standard EI programs. These were completely kind of unchecked, unverified, and the scale at which this happened was enormous. And so you have a ton of capital for those who do need it to support themselves, and a lot of capital available to people who didn't need the help to support themselves, and record low borrowing rates. So you're not going to have the best decisions made with that kind of free money.
Hey, if you're enjoying this content, you're enjoying this format, particularly having Devin on, please hit that like and subscribe. That'll let me know that you enjoy this. I'll make sure that I bring more of this sort of format and concepts to you in the future. Thanks so much. Let's get back into it. Just to remind people very quickly, besides the helicopter money to mid-sized small businesses, direct consumers, you also had things like deferred payments. So people were deferring mortgage payment obligations, auto loan obligations, outstanding credit balance obligations months down the road, and obviously at these low borrowing costs. And a lot of people eventually chose to roll that debt into their household debt, larger mortgages, and now things have sort of come home to roost, where the borrowing costs have climbed quickly on all that spending and all that accumulated unsecured debt. Today, obviously, we have one of our highest household debt to GDP readings on record, and we're slowly starting to see the fallout of all those things. But that begs a lot of questions moving forward. So we're going to have a lot of consumers, and we're going to categorize them into two buckets. And the first one I really want to discuss is anybody who's a pre-existing homeowner. They've had a mortgage locked in for the last few years at materially lower rates than what the market is working with today. So these are mortgages that are coming up for renewal in 2023. What can people expect moving forward? So Dev, for somebody who's got a mortgage coming up, maybe you could shed a little bit of light on how they might be impacted by this new rate environment.
Most mortgages in Canada run on a 5-year term. So you can assume that if everyone's got a 5-year term, roughly 20% of anyone with an existing mortgage comes up to renewal in every calendar year. So we're looking at, for anyone who took a 5-year term in 2018, you're probably coming up to renewal this year, unless you've broken your term or made some other changes. 20% of people, that's a lot of people that are going to be stuck with a decision that will probably surprise them. When they were looking at rates in 2018, they were probably looking somewhere between 3.25% to 3.75%. We're now looking at interest rates much higher, into the mid fives, even as high as low sixes. And then if they're on the alternative side of things, they're probably looking at rates in the high sixes or low sevens. We're talking a net 3%, 3.5%, maybe 2.5% difference in interest rates. And
an increase on actual payments of 50 to 70%, depending on somebody's amortization, et cetera. Yeah.
Right. And so there are a few ways to help tackle that shock. Obviously, you can try and requalify for a mortgage, which means submitting a new application, going through the approval process again. The challenge is with the stress test, you're stress testing at 2% above whatever that interest rate is that you're looking to qualify at. So if you're looking at 5.5%, you're stress testing at 7.5%. That is the highest level of stress testing we've ever seen in Canada when it comes to a mortgage qualifying. So it is, record or
recent records, certainly
recent records. But it's also definitely the hardest time to qualify for a mortgage in recent memory. So, there are options for sure, but it's not necessarily going to be what everyone is able to do or to qualify for. So that leads you to renewal. So just quickly, renewal is when you come to the end of your mortgage term. Your mortgage term is really just however long you've decided to lock in that interest rate for. At renewal, you're given a few options. Typically, you're offered by your lender a set of new terms and interest rates corresponding to those terms. And you can choose to just continue your mortgage with them at whatever the rates they're looking to offer. It does also give you, though, an opportunity to shop around, make changes to the mortgage, because for the one time in a Canadian mortgage, at renewal is when you're not triggering a penalty to either pay it off or make some material changes. You have full flexibility on what you want to do with it. Renewals, typically, your banks will come up to you with an offer 2 to 3 months before. Something that can happen, and something we are seeing more frequently today, is something called an early renewal offer. This is when your lender will reach out to you, typically about 6 months or as early as 6 months ahead of your renewal date, and provide you with a set of special rates that you can choose to take advantage of today or within the next week, whatever the time frame it is that they give you. And that gives you, and so effectively what you would have to determine is, do you take these rates today and actually change your mortgage, giving up the remaining 6 months in your existing term without any sort of penalty? Now, in scenarios where the rates being offered are lower than the current rate you're paying, for a lot of people, that makes a lot of sense. Why not take advantage of the lower rate? You're gonna gain 6 months at a much lower interest rate without triggering a penalty. In scenarios where rates are much higher than your current interest rate, there's really a few considerations that people have to be taking into account. Firstly is, you're immediately giving up the remaining 6 months or 5 months or how many more months you have on your term. And just to put that into perspective, you're looking at a 3% difference on 100,000, or for every 100,000 in mortgage, that's an extra 3,000 a year in interest for that $100,000. You divide it by 2 for 6 months, 1,500. You've got a $500,000 mortgage. You're looking at 7,500 in extra interest that you're going to guarantee yourself to pay over the next 6 months. A tricky decision to make that kind of call when there is no guarantee that the rates being offered to you today are going to be higher than those you will be able to take on at time of renewal in 6 months. And it's really forcing a lot of people to speculate on where interest rates are going. And we know just, professionally, that speculating on interest rates is an incredibly difficult thing to do. You go back to earlier in 2022, there were a lot of projections from the big banks in Canada as to how high or how fast the Bank of Canada would be able to raise interest rates. And the most aggressive was Scotiabank with, I think, 8 rate hikes of 25 basis points. Well, we've doubled that. So even the professionals, even the chief economists at banks, were completely off when it comes to estimates, and that's likely to continue. We don't know how fast interest rates are going to continue to move either up or down, and making a decision based on speculation of that is always tricky.
Dev, for a lot of folks, they're going to be coming up for renewal. Once upon a time, they qualified at a mortgage rate of, at a maximum of 525, which was the higher of the borrowing criteria for the stress test rate. Now, both mortgage rates and qualifying rates are meaningfully higher. And there is going to be a contingent of people that can no longer requalify the same mortgage with the same A lenders. And in a sort of worst case scenario, they may have also accumulated some unsecured debt. And they're going to come up and they're going to have the option to potentially renew their mortgage and leave their high interest debt open. What options does a person like that have in order to consolidate their debt and improve their cash flow?
Yeah, renewals are usually a phenomenal time to take advantage of rolling in high interest debt. Canadians year after year have gone back to the home equity piggy bank and continued to lump in higher interest debt because it is definitely the right decision to do. It helps alleviate a lot of monthly cash flow pressures. And when you're able to pay off high interest debt with low interest debt, that is a financially prudent decision. The challenge today is obviously there, with higher costs of living, it does make it much easier to start going to unsecured lines of credit cards to help fund lifestyle. And with stress test rates at where they are today, the reality is many people are not actually able to qualify to potentially consolidate everything with the prime lenders. So that's when you start to look at alternative lending options. These are guys like Equitable Bank, Community Trust, Optimum. Many of those are what you would call they're like private institutions that are backed by big banks. They provide like very specialized programs or extended borrowing ratios that allow us to increase our qualifying amount so that we can, secure the right amount of mortgage in order to be able to pay off the debts. They do come at, higher rates. There are additional costs to them. So it's always a process of reviewing exactly what the costs are to do a consolidation and what are the benefits to the individual client. A lot of it's very personalized, and that also brings into consideration other questions as to how fast are they actually going to be able to pay off this debt.
Mm-hmm. So obviously those are some of the considerations for anyone who is an existing homeowner. They have a mortgage coming up for renewal. We discuss what options they're going to have to early renew, whether or not that's a good idea. And now there's this other contingency of folks. That's anybody who's looking to make a new home purchase or who has a mortgage up for renewal, and they got to choose between a fixed or a variable. Now, these folks have to decide between a variable rate mortgage, which today is actually priced higher than a fixed rate mortgage, which is quite unusual. All mortgage rates are typically hovering just above 5% right now, with the median rate, depending on type of mortgage, roughly around 5.5%. With that in mind, how do you think somebody should be thinking about the decision of whether they should be taking a fixed or a variable rate mortgage today?
Well, we do this with every client we talk to, is really getting a better understanding of what their overall financial goals are, but also getting a better understanding of what their plan is for the property. We know that the decision between fixed and variable is often guided by how long are they expecting to either be in the house or potentially need to be making any sort of changes on to their mortgage. Are they expecting big lifestyle changes, potential workup changes? Are they going to have to move again in short term? Are they planning on living here for a few years and then turning it into a rental? All those different things come into play. But if we're just narrowing it down to fixed versus variable, it kind of helps to understand, why variables are currently priced higher than fixed, why fixed are a little bit lower, and then even within, the different terms available in 1, 2, 3, 4, 5-year fixed options, you're seeing the shorter term fixed at a much higher level than you are seeing longer term fixed. We know this just simply because it's the yield curves are inverted. The longer term rates are lower than short-term rates. The economy is effectively signaling that they're expecting some sort of recession, or there's uncertainty in the market. They don't like it, and so that's where you see the shorter-term rates much higher than the long-term rates. That also begs the question of, well, fixed rates and variable rates, they're tied to different things when it comes to what helps determine the cost of funding, or what helps determine what rates are passed along to clients. Fixed rates, we know they're tied to the Bank of Canada bond yields, or more accurately, the swaps on those yields. But there's a pretty direct correlation between the bond yields and the fixed rate mortgages that clients can go out and obtain. When you've got a scenario where fixed rates are lower than the variable rates, that is the bond market predicting that rates will effectively drop, or there should be some cuts coming at whatever time frame to the Bank of Canada prime rate. The Bank of Canada prime rate is really the only tool the Bank of Canada has right now to help tackle inflation, and that's their overnight lending rate. That's what the variables are tied directly to. It's and there is some risk right now that the Bank of Canada does continue to increase that prime rate, because it is one of the few things that they do have to properly help keep inflation in check, or to try and get short-term rates above levels of inflation.
So, the question of even what product is appropriate, a lot of it goes back to sort of risk aversion. How comfortable are you with volatility? Because there's two things that we are quite confident in. One, that rates will likely rise incrementally further. It's a higher probability event that rates will rise a little bit further, as opposed to we're done with rate hikes. But that's in the short term. And that would be done with the purpose of accelerating our path down from the current rate of inflation down towards the central bank's 2% target. There's this general consensus and understanding, both between the bond market, which are traders purchasing futures contracts that sort of make assumptions about what the direction of interest rates is going to be, and even central bankers themselves. And everyone agrees we will see we will see rate cuts. The question is when and on what sort of timeline, and how far will rates increase before they start to fall. So when we're talking about, which product is more appropriate, there has to be an understanding that in the same way that in 2020, 2021, when there was a huge spread between variable and fixed rates, there was an understanding that variable rates would eventually rise. And the question was at what pace? Right now, with a gap of roughly 80 basis points, with variable being higher than fixed rates, variable rates may rise in the short term, but there's every expectation they will fall in the midterm. So somebody has to be comfortable with that understanding of the directionality of rates. And in that process, we can actually explore also a tool called the Fed dot plot, and that'll actually set the expectations for what central bankers are estimating will happen with rates in 2023, 2024, 2025, and beyond. So this is the Fed dot plot. It's basically the Federal Open Market Committee participants' assessment of what they anticipate will happen with the overnight lending rate, which is basically mortgage rates, moving through 2023, 24, 25, and into the longer run. If we look specifically at 2023, the Open Committee expects that rates are going to peak somewhere around 5.15%. The current rate we have is 4.25, so we might see an additional 90 basis points of hikes. In all likelihood, it'll be a round number, but that's where the consensus estimate is. You could see some committee members expect it a little higher, some expect a little bit lower. The range is as low as 4.75 to a high of about roughly 5.7. So that's the range of estimates. In 2024, the market actually expects rates to begin their rate cutting cycle. And that rate cutting will actually drive rates down to an expected range of about 4.25% from 5.15%. So roughly 90 basis points of cuts between 23 and 2024, and then further cutting all the way down to potentially as low as 3.15 by 2025. So from 5.15 to 3.15 would be 200 basis points of cuts from the peak in 2023, which, for example, right now estimates have it roughly around June, July. By middle of 2025, we could see 200 basis points of cuts from that level. That means that by the midpoint of 2025, Fed committee members project that we're going to be nearly 1% lower than where rates are currently sitting today. So just to add that little bit of context, Dev, can you help us understand, the blue line is basically the committee members. What is that little red dot and why is it persistently lower than the blue dot?
Yeah, well, the red dot's effectively it's the market's estimate of where rates are going to be. The market is more likely to be aggressive on their estimates. They're also
quick thing, Dev. What's the market? People keep hearing that. What is the market?
Well, the market is just the culmination of all trades related to bond pricing in the world. So you've got buyers from every part of the world, institutions, individuals purchasing bonds or selling bonds, which drives rates up and or down. But more particularly, these are the U.S. Fed interest rates for the U.S. overnight lending rate. This is the market effectively trading around the probability as to where that rate will land.
Mm-hmm. So when people look at 2-year, 5-year, 10-year, 30-year bond yields, that's the market expectation.
Yeah, exactly.
And basically, if we look across this Fed dot plot, we look at that red line, we could see it's pretty clear. The market persistently expects to be lower, potentially higher in 2025. So the market's pricing in some additional circumstances, which we're going to talk about later. Something like a double top in inflation could play out. But in the short term, over 2023, 2024, the market expects that central bankers are setting up kind of a false flag. And in fact, they're going to pivot on rate hikes sooner rather than later and begin their rate cutting schedule sooner rather than later.
Yeah. And just to put it into perspective for Canadian borrowers, the Canadian Bank of Canada is actually have rates set in line with what the US does right now. So if things go as expected, or as the blue line would indicate, kind of the average consensus, you'd likely see another 0.75% increase from where we are today. And then into 2024 is where you start to see those cuts all the way back down to where we are roughly today, maybe even 25 or 50 basis points lower than where we are. So it's possible you do see some rise in further interest rates on the variable rate side before seeing very likely of 1%, 1.25% in cuts early 2024.
Yeah. When I think about interest rates, it's been quite a phenomenon being inside the industry and just being a consumer myself. You got a lot of conversations that take place around how obvious it was with the foresight that we have today. Who could possibly have taken a variable rate mortgage? How badly did they mess up? What a miscalculation. The benefits of hindsight obviously are 2020. And we want to understand that this sort of incredible ascension in borrowing costs happened directly off the back of a war that broke out in late February, early March. Then unexpected lockdowns in the largest exporting country in the world, in China, which only recently sort of have reopened, and then incredible drought conditions across food producing nations. And as sort of a result of all these things, you have the fastest pace of increase in interest rates in hopes of quickly quelling inflation. In the past, central bankers used to very, very slowly hike rates, and that inflation would persist for longer periods. Then it would get entrenched in the economy and you'd see a lot more pressure on wages. Central bankers now have figured out the playbook, or at least they believe they have, and they're trying to learn from past mistakes. That's why you have central bankers speaking out in front of politicians, talking about the importance of suppressing public sector wages. An extraordinary turn of events, but that's because we've learned a lot from past experience. We're trying not to make the same mistakes of the past that will make this a more prolonged period of pain.
Just to add as well,
please.
I mean, like sometimes the context helps when you're looking at central bankers talking to politicians, asking to keep wages low. The main reason that kind of even comes up is wage inflation is where you start to see prolonged inflation really get entrenched. If people continue to earn more, they continue to spend more, even when costs of goods are rising. The way to kill inflation is to effectively cut spending, and that will give goods time to catch up in terms of supply so that they can meet demand, meaning they don't have to continue to rise in prices. The minute you start to see wages increase, that's where you do start to see things start to run away, and it does become way more difficult to control.
It's really sort of an interesting conundrum because some things are pretty clear to anybody paying close attention. It's pretty clear that leading indicators are showing a lower path for inflation moving forward, but also a lot less economic activity moving forward. So we've seen manufacturing output fall for 7 straight months. Inventories are growing. GDP growth is decelerating substantially. Housing market is falling in a material way transactionally and in prices. Real consumption is falling. It's pretty clear the economy is heading for a huge slowdown. And it's important to understand that this is actually an induced slowdown. It's intentional. And central bankers have already said that they prefer to knock the economy down on its ass. And if they need to, they're going to resuscitate it. But we have to walk a thin line because one of the reasons why you see bond traders pricing potentially higher rates than the Feds by 2025 is there's this phenomenon of double top of inflation. We know the economy is going to slow. We know there's going to be a lot of political pressure to drop those interest rates when they do. Political pressure, special interest group pressure. What's the consequence of dropping rates too quickly in response to a slowing economy? And what could potentially be the drawbacks of that?
That's exactly what happened in the 70s and 80s. They thought they had inflation under control. They started to drop rates too quickly, and unfortunately, some of those key drivers of inflation were still there, persisted through, and then re-accelerated. And that's very similar to what the central banks are looking at today, and what they're very much so wanting to avoid. I mean, the one thing that I think it was Powell said this out of the U.S. He says we have the tools to reignite an economy. We can actually stimulate until there is no more need to.
We've seen
to bring things back to life.
We've
right.
seen what they can do.
Right. What we don't have appropriate tools to do is to kill inflation very quickly. So sometimes we have to overdo the correction policy to fix this in the hopes that we will be able to bring it back to life at a later date, which we know we can. So it's kind of they're taking a more strict approach to raising rates today, because it's really the better alternative than letting inflation run away like the 70s and 80s period that we did see, because we just don't have the appropriate tools for that.
Yeah, it's pretty clear, their strategy seems to be to sort of dry people out, take all the dry powder off the table. We've got a low participation rate in the economy, which means you got a lot of people who became accustomed to whatever new circumstances have played out, and there's less people of working age participating in the job market. So keeping these wages high. Yeah.
We're also seeing, a large part of our population, the baby booming generation, that are starting to retire. We shut off immigration for 2 years. All those things have a compounding effect, in addition to a much, a greatly reduced supply of goods and an enormous amount of demand.
Yeah, it's pretty clear that a lot of the leading indications, just from a labor standpoint, economic activity, commodity prices, a lot of these input costs and leading indicators are telling us the economy will slow down. There will be an obvious peak for interest rates, and there's certainly a lot of rationale for why those rate cuts will begin either later this year or early 2024. But assuming it doesn't sort of turn immediately, it begs the question, if somebody owns a home now, they're sitting in a variable rate mortgage. They took that mortgage in late 2021 or early 2022. They've got steep discounts. So prime minus 1.25, minus 1.3, minus 1.4. But they're uncomfortable because they've seen that borrowing cost rise. They might be in their trigger rate. They're receiving solicitation from their bank about switching from variable rate to fixed. What's a person to do?
Yeah, they want to make a very calculated decision. I mean, most people have the option from a variable rate to lock into a fixed rate, typically with no cost. Now, what terms are available to them, that's going to depend on the bank. Some banks will be greater than or equal to the remaining term. Others will have, a few more options available without triggering the penalty. But one thing they really want to keep an eye out on is we do expect rates to come down, so long as the leading indicators continue to provide the data that they are consistently showing and have been for the last 7 or 8 months. So, individuals with very deep discounts are probably still sitting around the 5.5%. Some of them are even still down in and around, low fives, roughly equivalent to what a 5-year fixed rate would be on the market today. You may have a small premium to your variables, but the understanding is that, variables will come back down as the central banks no longer need to keep rates in a contractionary environment, which right now they are. Anything above that neutral range, which is between 2.5% and 3%, 3.5% on the Bank of Canada's overnight rate territory. That's where they are actually trying to hit the brakes on the economy. They don't do that in a scenario where inflation targets are back between their 1% to 3% range. And I don't expect that when inflation does get down there, that rates would stay contractionary.
Dev, let's also be mindful of the fact of what we've seen as far as what is a variable rate product. Well, there's the two components, right? We've got prime and then we've got the discount. And if you took a variable rate mortgage and you're in this boat, you might be sitting in the trigger rate. Typically, your discount to prime was in a range of somewhere between minus 90 basis points and as much as prime minus 1.4%. That's sort of the general spectrum that we had seen them on over that time period.
Yeah.
Now we're looking at variable rate products. What sort of median discount are you seeing out there on a variable rate?
Yeah, recently improved, but improved should be used lightly. You're probably looking at anywhere from prime minus 0.25, prime minus, up to prime minus 0.40. So, those discounts are dramatically lower, and prime is obviously dramatically higher. It's a very different conversation when you're looking at interest rates today versus those who are making the decision, having already received or having a much steeper discount than what's available. The nice thing with those steep discounts is, as prime inevitably does come back down, you're still able to take advantage of that discount until the end of your term, which means you could creep down to rates much lower than where they end up settling once this inflation is quelled, just because you've got a dramatically large discount, and something that we're not likely to see for quite some time in the market.
So it's just something to be mindful of. There's no sense in rehashing the discussion of, was it a better opportunity to take a variable rate in early 2022 or a fixed rate? It's pretty clear if somebody could go back in time, they probably would have taken a fixed rate in the high twos or very low threes. But today, it's a more difficult question. Should you switch from a variable rate to today's fixed rates? And considering the discounts that were available on prime at that time, that's a difference of about 80 basis points between a variable rate mortgage from 2020, 2021 versus a variable rate mortgage available today. And those terms still have 36, 48 months remaining. So if those rates continue to trend down, there's a lot to be said, obviously, for maintaining the discount on that variable rate as opposed to switching the fixed. Also really important to be mindful. When you switch from that variable rate to a fixed rate, your amortization will get reset to a maximum 30 years. And that's almost certainly going to be reflected in a much higher payment than whatever you're currently carrying on that variable rate mortgage. So if you choose to go that route, just make sure that you're conscious of that. Have the lender quote you what your new payment's going to be so that you can have all the information at hand.
Let's maybe just explain why that amortization piece is really important. There's two variable rates that you can get in Canada. You've got your static payment variable or your adjustable rate. Adjustable rate, that's where your monthly payment moves up and down with rates. Your static payment variable stays the same, but your interest to principal component or effectively your amortization, how long it's going to take you to repay the mortgage, adjusts when rates go up and or down. Anyone who took a variable rate in 2020, 2021 is very likely in amortizations well above the maximum range, which is 30 years for banks. That maximum range of amortizations is set by the B20 guidelines. So the having those very much so extended amortizations are going to come to roost when you are looking to make changes and going from a variable to a fixed rate, because they do have to bring that amortization back in line. Now, that's more likely to come up at renewals for variable rate holders today, assuming rates stay where they are today. The reality is your amortization is going to start to decrease as prime rate decreases as well, because your payment is going to readjust with every rate cut to be paying off more and more principal down the road. So there's a whole kind of other set of conversations that we're having with people who have variable rates who want to either try and get ahead of managing that amortization adjustment. I know a lot of lenders as well are calling individuals who are either at their trigger rate or close to it to provide them with some options. I have heard of people being offered interest-only payments for short periods of time, 40-year amortizations for short periods of time. So there are some tools out there, and lenders are definitely working with people. But one of the bigger things to consider, definitely when you're making that decision, is to locking in. Is part of the reason a lot of people pick the variable rates is because the payments were super low. For anyone in those static payment variables, those payments are still quite low in comparison to the equivalent 5-year fixed rate payments would be today. And can you manage that cash flow change? That's maybe not the right thing for you. And there's maybe alternative options that you could look at to better manage cash flow. At the end of the day, cash is king. If you can't afford your mortgage payment, it doesn't matter what your mortgage payment is.
Yeah. There's a lot of questions that people are obviously grappling with right now. There's obviously questions around what to do with their mortgage. Then you've got the second contingent of people who remain employed. Assets have certainly fallen in value, but they're still pretty liquid. They've seen home prices correct already in a pretty meaningful way. Should somebody consider the purchase of a new resale property right now, or would they be better off looking at pre-construction? Is now the right time to step into the market? What are you thinking?
Yeah, these are really tricky questions because they are entirely speculation. I would say resale is a little bit more predictable right now.
Actually, Dev, let me make it a little bit easier on you. Let me break this up into two buckets, because I think the reality of people watching are end users. You got some people who are individuals or families, and they're considering the purchase of a new home for them to actually occupy and live in. And they're trying to decide, should they be speculating or should they be buying right now? And then you've got the second contingent, which are people that might be speculating on additional property to be used for the purpose of long-term rentals, etc. Let's maybe break those two apart. If you've got a family and you're thinking, is now the right time? What are some of the reasons why, despite the lack of affordability, why would somebody consider going out to make a purchase right now? What are some of the
Well,
benefits?
yeah, I mean, at the end of the day, if you've got a family, you need a place to live. You're going to have shelter costs, regardless of whether you're choosing to rent, whether you're choosing to stay where you are, or looking to buy. There's always different things that that are going to force you to make a decision that are irrespective of market conditions. If you need to upgrade your home, you need to make a change for the betterment of your family. That is more likely to suit you better over the long run than it is trying to time the market. Timing the market, we know, is a nightmare decision. Um, when we're looking at even affordability, you have to measure what you can afford based on your monthly payments today, and help that guide your decisions rather than trying to time the market. You try and time the market from a pricing perspective. It's a very difficult thing to do.
I always hear from families when the market's hot, the general narrative that I hear from families who are looking to get into the market for the first time or are looking to upsize their home, they can't find the footprint they're looking for, or they wait until they find that perfect footprint. They go in with a relatively aggressive offer and 12 people outbid them on that property. And they're they find themselves back to phase one.
Only
I
12.
say all that to kind of say that you've got a couple of challenges in front of you if you're going to choose to speculate on the market. One, you got to be right about your speculation in price. Two, you got to be correct about your speculation in borrowing costs. And three, when that time comes, how competitive will the market be? Will you be able to actually find that property that you're seeking to find for your family? Lastly, what sort of timelines are you on? Do you have kids whom you want to put into school and basically start that period of your life and their life? Is it worth the potential speculation both on price and borrowing cost? Or is the priority just to find the footprint at a payment that you can afford, that you can comfortably qualify, and take and alleviate some of that risk and some of that thought and things that consume you? So I think that's the bigger argument for anybody looking to buy today. Setting aside the discussion of will home prices be lower in June 2023 than they are now, and what will happen with borrowing costs, that's just something that people have to be very conscious of when making that decision. Then the second part, Dev, let's look at it from a more technical lens, from an affordability standpoint. Let's look at the different municipalities, and we'll bring up a chart here to kind of support the discussion. But right now we're looking at what income is required to qualify a mortgage in various areas of Canada. And we could see that those numbers change in a really meaningful way from the third quarter of 2021 to the third quarter of 2022. Given some of the leading indicators we've already talked about, we know the money supply has basically turned negative this year for the first time in, I want to say on record, or certainly in this generation. What are we expecting? What are some of the considerations for somebody looking to purchase a new rental property?
Yeah, well, for rentals specifically, the numbers need to make sense. Now, traditionally, Toronto investors have been able to, put their crutch on capital appreciation in order to generate returns, which is the fact that their prices were going to appreciate at a much faster pace than their rental yield would, or the income being generated by the property. We're starting to see a much stronger return of a focus on yield. And why would that be the case? Well, when you can go out and buy risk-free return assets like GICs, like T-bills,
Savings
and
accounts.
those, high interest savings accounts are in the 3-4% range. There's not a lot of appetite for someone looking to go out and speculate on a rental property that's, providing a cap rate of 3 or 4%, which is for a long time where those Toronto and other GTA properties have focused or have been selling at. So I do think you will see perhaps a reduction in the number of people looking to purchase properties for the sole purpose of rental income or speculation on the market, simply because that certainty of housing appreciation at the same record levels aren't necessarily there. And when you have a risk-free rate at levels that we do today in that 4 to 5% range, you do need to attract a certain percentage of risk premium when you are taking on an asset with some risk. And housing, in Toronto for the last 15 years has effectively been risk-free. The market's continuously increased. The reality is today, with more uncertainty in the market, that does add risk. And that's where you're starting to see a change in that kind of appetite for purchases.
Yeah.
One thing I think we should chat about, or maybe some of the scenarios coming up with new construction projects. I was reading earlier there was we're expecting a record number of units to be delivered to the market this year.
Yeah, condo units.
Yeah, condo units specifically, which is most of what like the pre-construction market comprises of. But just think about the challenges that some of those buyers are going to have, and maybe even like why they'll run into challenges. Well, when you're closing a new build property, you still have to go through the same mortgage qualifying that you do as though you're buying a home that closes in 2 to 3 months. So the banks are always going to require an appraisal. And an appraisal is just a professional opinion of the value of the home, and they do a comparison between 3 or 4 or 5 different properties similar to that one, and it's always based on a recent comparables that have sold. So if properties are no longer selling around the same level that you paid for the home, you could be stuck managing a shortfall, meaning you would have to come up with some additional cash as a down payment. Now, a lot of people would not be expecting to do this because it's been unheard of. But over the last 15 years, 20 years, developers have seen end users or speculators generate massive returns by putting down deposits on new investment or new condominiums, and then assigning those purchases much closer to closing, or closing on them and then flipping them, within a very short period of time. So they started to attach premiums to current resale pricing per square foot to try and alleviate some of those pressures. Now, the market has been outpacing those premiums that were attached to them, so it's still been very worthwhile. But properties that had a premium attached to them in 2020 or 2021 were obviously at market value levels that we're just not seeing today for the equivalent properties, and that could cause some stress. So we may see an increase of assignments, people looking to try and sell off the purchase of the unit, either get their money back, perhaps get only take a small loss in the event that appraisals, we do see them coming back lower than not. Just an interesting thing to keep an eye out on this year, because that could be a big story that plays out.
There's no question. That's almost the worst case scenario, is that somebody has to bridge that shortfall when their new purchase appraises low. And then somewhere on that spectrum, even before that worst case scenario, is the reality of, can they qualify the mortgage based on today's qualifying rates, which are dramatically higher than what they would have been when they got their original pre-approval letter once upon a time when they signed on that purchase and sale agreement.
Yeah,
there's going to be this addition.
It's so hard. I was going to say too, because it's so hard when you're out buying a resale property. You're using a realtor. They're looking in real time at comparables for you. When you're out buying, these pre-construction, yes, there are advantages to them. You get to customize the units. There's flexibility on when you have to come out with those down payments, but you don't really have much negotiation when it comes to sale price of the property, and you are taking on the risk that the premium is going to be worth its while for delivery in 4, 5, 6, 7 years. You don't necessarily have that same expert helping you or helping guide you through that comparables analysis. And unfortunately, we are likely to see more of these kind of worst case scenarios into this year. Whereas you do see very few of those kinds of things on a resale purchase. Every once in a while, someone will have overpaid because that's the property of their dreams and that's what it was going to take to get it. But more often than not, properties come in at the right value because the analysis and the due diligence has been done by the realtor.
Man, there's so many themes that we could dig into. I think I'm patting both of us on the back right now for not going on too many tangents. Certainly that's some we are guilty of in our personal conversations offline. I'm glad we're able to avoid it for the most part here. If there was anything that you felt like we didn't cover, then I strongly encourage you guys to get into the comments, leave us some feedback. If you want to tell us that we're completely off on a lot of these presumptions that we've made, please let us know in the comments. Happy to duke it out with you there. As always, though, thank you so much for tuning in. It would really, really mean a lot to me, particularly in this video, if you could take the time, if you enjoyed this format, if you enjoy this sort of commentary, you'd like to see more videos like this, if you could hit that subscribe, hit that like button, it'll let me know that you enjoy this format. And I would certainly be very happy to have Devin on and make this more of a full-time format and thing that we bring to the market. So again, thanks so much for tuning in and look forward to seeing you in the next one.